Good evening. I'm Peter Resnick from ShadowTrader.net, and this, of course, is the weekend edition. Good to be back with you as always. Kind of a crazy week in the markets, a lot of back and forth, a little bit down for the major averages. There were two main stories that dominated the news this week. The first was on Tuesday when the weekly bond auction for the 20-year did not really garner as much interest as they had hoped. Only $16 billion worth of bonds got sold in that session, and that caused yields to spike and equities lower. And that kind of put a wrench into things a little bit early in the week. And then later on Friday morning, relatively early in the day, President said that he was threatening a 50% tariff on the EU because, quote unquote, negotiations with them were going nowhere. He also threatened a 25% tariff on Apple and any other phone makers that weren't making phones in America. So this also didn't bode well for the markets. Apple gapped down a lot on Friday morning, taking the futures with it. And we kind of had a two-way session on Friday. It was actually quite interesting because we had a large gap down, which then actually filled, which doesn't often happen on a very, very large gap. But then after filling the gap, only closed way back down in the midpoint of the session. So broad markets right now are in kind of a no man's land. We're going to get into the what's really going on segment shortly. And we're going to be talking about all of the different kind of areas where the broad market is, vis-a-vis trend lines, 821 EMAs, etc. And you'll see that, to me, there's kind of no man's land here, with the potential, I should say, of rolling over and moving lower. But right now it's just a potential. So I'm not really stepping on anything short or getting any exposure in that direction just yet. But I am keeping an eye on it. So we're going to talk about that and a lot more in today's weekend edition. Okay, starting off with just a slight look backwards, as we always do, kicking off these programs with the weekend review, where we look at where major averages and the 11 sectors that make up the S&P, how they traded all week. Remember, always measured from Monday's open to Friday's close. So if some of these numbers don't look exactly right to you, remember, I'm not interested in the gap. I'm interested in just the actual movement of where we started when the bell rang on Monday morning to where the bell closed on Friday afternoon. So taking a look at majors first here in our weekend review, you can see obviously all down a bit, not majorly, about 1.5% in the S&P, 1% in the NASDAQ. Russell was down about 2%. And sectors pretty much confirming, no big difference, right? I mean, tech off a couple of percent. Tech and financials, of course, the most important. These two together make up such a huge portion of the market. They're very, very important. There's a little bit of outlying strength in industrials, but overall, none of this was really major in terms of any really big outliers to the upside or downside. Energy was probably one of the weaker sectors, but it's been kind of weak. I feel like crude is just kind of languishing at the price it is, and it's just holding these energy stocks a bit lower. XLV was down another 2%. This is interesting to me because there was hints of a rebound last week, and that kind of fell apart. And now I think that this is actually going to move a bit lower. Healthcare, I think, still has one more leg lower. As you know, this has been the weakest sector out there for a while. And recently exacerbated, I should say, mostly by that UNH. And that UNH is not really bouncing, as we know. It's just kind of sitting down there. And I think there is potential for one more leg lower in the healthcare. And if so, it's probably going to come to a buyable area after that. As far as everything else, bonds, still just a waste of a trade. I still telling everybody just stay away from that. There's not going to be any big rebound in bonds. I just don't see it. It's just kind of dribbling lower. It's a tough one to trade because it's kind of one day up, one day down. But overall, the trend just remains down. Yields actually ended up backing off when you look at the whole week from Monday to Friday, even though there were those surges in yield. Volatility popped up, obviously, because we were down quite a bit. And gold had a fantastic week. We're going to be talking about gold a little bit later on in the show. I know I talk about gold a lot in this program, but one of the reasons for that is the fact that when the equity market is difficult, and I do believe this is a difficult market. I am definitely not one to ever complain about a market. I am not one to ever make excuses about a market. I feel like if I have losses in the market, it's absolutely my fault. I never blame the market. But I will say there are markets that are more difficult than others. There are markets that are more news-driven than others. This is that market. This is quite a difficult market. when it is that way regarding equities, you want to be looking at things that are working, that are easier. And that's why I constantly keep talking about gold, because gold is relatively easy right now, right? Whatever pullbacks it has, it immediately gets bought back up. And that's why I keep advocating for the short puts on the gold futures and also buying the gold futures on pullbacks and getting a directional run going. Okay, very, very important. All right, Bitcoin, or oil rather, down quite a bit. Tying in with that XLE, and Bitcoin made a new record this week, somewhere in the 111,000. Don't quote me on that. Could have been 113. I apologize for not knowing the exact amount, but Bitcoin made a new record this week, but then pulled back pretty sharply. It was off about over $3,000 in the Friday session. Probably pullbacks are going to be viable in Bitcoin from here on in, since you've already made that retracement all the way up to the high. So we'll see where it can go from here. And that is our weekend review. Okay, what's really going on? This is where the rubber meets the road, where we look forward to try to see what the technicals are telling us about what the market may be doing next week, which is very, very important. We're going to look at the S&P and the NASDAQ 100, and then also we are going to get off the cash market and go into the futures market, because obviously with the 24-hour nature of the futures, those charts look slightly different. And given that we're in kind of a no man's land right now, sort of a technical limbo, and I'll show you why in a second, I think it's important that we look at both types of charts. So let's begin with the S&P here on the daily. And first thing you'll note is that I've marked off these horizontal levels specifically because they are the gap. And a gap is always from the top of a candle to the bottom of another candle and vice versa. It is never ever to the close. The gap is actually the part on the chart that's the actual space. So that means it's from the low of one bar to the high of the other bar. And this is very, very important. A lot of people, I think, mistakenly look at gaps using closes or things like that, or opens or whatever, but that's really the gap. That's why in market profile terminology, we call it either true gap or non-true gap, right? A non-true gap is one that opens up within a range. A true gap is one that opens outside of range. So that being said, the activity today where we fell down on the gap down on the tariff news, you can see we fell down, went just a little bit lower, and then rallied up to fill the gap, which we'll talk about a little bit more. We're going to do a little bit of profile in a moment, but notice where this puts us, like trend line wise. Like literally we're sitting like right on trend with a huge portion here of the gap that is as yet unfilled. So the question is for next week, is this going to hold this trend line and actually rally? Or if we go lower, it's probably going to fill trend, or definitively break trend, and fill the gap. And that's going to put us to 56.91.69. I've written down the exact levels here. The gap is from 86.08 to 56.91.69. So just keep that in mind, that if it is lower from here, you're probably going to do a full gap fill. And note that you've also got a 21 supporting you right here, which I think also makes things a little bit tricky, right? Because you will more than likely catch some support there first. Could it be a situation where you test that 21, bounce a little retest? That's a scenario for a potential short to take you down to the support level here at the top of the gap? Perhaps, I don't know. And how does this bode for the bigger picture? This is why I was saying in the introduction to this show that there is potential here for a rollover. We are threatening to break trend. We're in between the 8 and the 21. We don't have a pinch to the downside yet. But remember, whenever we get a pinch, it tends to set things up in that direction for some time. These are the last two pinches. Pinch just means when the fast moving average moves through the slow one. And when the 8 moved through the 21 back in March, that kicked off a downtrend. When the 8 moved through the 21 to the upside here in April, that kicked off this uptrend. And now you can see that this 8 is starting to roll over. You've got a downward trajectory today. So the question is, does it hit the 21 and pinch? If so, then you're probably going to see some lower prices there. But for now, I wouldn't get too short. Nothing has really happened yet. Just kind of wait it out. Remember, there are times in the market where it behooves you to actually do nothing rather than do something. And this may be one of those times. Let's move on to the NDX and the cash here. A little bit different chart in that it's showing some relative strength. How do we know that? Because it is above trend. Notice that same trend line that we drew in the S&P and looking at the 21, we are way above that. So the NASDAQ has ways to go just to get to the top of the gap, never mind the bottom of the gap. The top of the gap would be here in the NASDAQ, right? And the bottom of the gap would be in this section. So we haven't even gotten there. So this is another thing also to keep in mind. If you are thinking of shorting the market, you need to be aware of the interplay between these multiple markets, because it is very important. I've addressed this dynamic many times in the past, and it's very, very important, is that sometimes traders will focus only on one market. And let's say they're not paying any attention, in this case, to what the NDX is doing. They're only looking at that S&P, and they see that that S&P might be moving below that 21, and they take that as a short signal. In a vacuum, if nothing else existed, it would be a short signal. But if you take that short signal and the NASDAQ is still above its 21, and right when you take that signal short on the S&P, let's say the NDX is right here, just above the 21, then you're doing yourself a disservice, because more than likely that market is going to reverse. When the NASDAQ hits support, it's going to pull the S&P with it, and it's going to screw up your trade. So you want to have a confluence of signals always, and of all your TA working together and moving below key areas at the same time. Just keep that in mind. So NASDAQ obviously a bit stronger, as I was saying, above the 8 and above the 21, and both of the, or above the 21 rather, under the 8. And both of these markets as well, just the fact that we're having this discussion of being in between the two, that's generally problematic. You usually don't want to be there. The area where it's in between is kind of a pause, and you're not sure what's going to happen, and it's got to kind of set up. And you see all this action here where they were kind of intertwined and close by. So as this gets closer, it gets a little more tricky. And either way, when you're inside of it, as we are now on both, I tend to think that's a little bit more neutral stance. Okay, as I was saying, let's look at the futures dailies. These are 24 hours just to see how they differ. So you can see that your ES lost your 21 here, but righted the ship. This was the trade action relatively early in the session when we gap filled. Obviously, this is a 24-hour chart. But again, is there potential for the rollover? We could move here, which would be the uptrend, which would put the futures at about 5,600. That could easily happen. You're at 58.14 right now. It's not that much of a stretch. So that's something I'm going to be potentially watching for to see if this ES starts to roll over. You can see that the secondary trend line here has been lost. The dominant is still here, the primary, and we'll see if we get to that or not. All right, let's go over to the NQ and see what that looks like. And similar situation, but a little bit stronger, as I was saying, in between the 821, not yet breaking the primary line, just kind of sitting right on the primary line. So this is also interesting to me. We'll see whether or not these NASDAQ futures will see the 21. And if they get through the 21, then what happens? You've got this congested area here that's probably going to be somewhat supportive. So I wouldn't be surprised if you kind of catch your footing somewhere in there. And all of this, really, that's the main takeaway to me, is the question is, even if the market was to roll over here, given the pattern that it's in, I think without a serious news catalyst, although it could get one, we're certainly in that season, right? This is these news catalysts are out there. They keep coming. We had the bond news. We have threats of tariffs again back in the news. Some of this stuff I believe might be going into effect. I believe June 1st. Don't quote me on that. So that also could rattle things. We're not that far away from there. So be aware that it's probably going to take some news catalyst to push this markedly lower. And if it does, then you want to kind of look at signposts of where you are from here, like in relation to potentially, I would say probably a Fibonacci retracement from the low, right? Like how far does it actually go? Like, can you actually get halfway? You haven't even really budged at all. You have to understand, you'd have to fall all the way to 19,000 in the NQ just to take back half of this rally, because this rally was so large. So I think my overall takeaway here is just one of caution, and two, just be nimble. Don't get yourself too overly committed to either side. You're also coming into the summer. You're going to probably have a little bit more two-sided trade. And I think at some point, whether it's sideways or whether it's down, the market will start to focus on rate cuts that are coming more in the back end of the year. Potentially, we've been looking at that Fed watch, looking at the Fed funds futures odds of a cut. And as we know, it's really kind of pushed out to September and beyond. And there was a Fed speaker recently, actually, who said that they were thinking it's only going to be one cut in 2025. So just something to think about is that at some point the market will start, hopefully the tariff stuff will be all behind us. And there won't be any other new news on that front. And eventually, I think the market starts to focus on potential for cuts. So we shall see. But that's thinking way ahead out deeper into the summer, into the fall of this year. But regardless, that's a technical picture in the markets right now and what is really going on. Let's get into a little bit of market profile now. We're going to look at some distributions in the ES, as we always do. This is essentially what I put the profile on, but you can profile with all sorts of futures, even equities. But generally, I use the market profile in the ES as an additional data point in my sort of view of everything. Adds an immense amount of context for me that I think is extremely helpful. So first things first is if you look at where we came from up here near the highs, we're starting to stack up a couple of VPOCs here, virgin points of control, back to back here, 520 and 521. Virgin point of control just means that it is the highest volume area of the day that remained untested. Almost always where the most volume trades in every day, which are the highlighted green areas, the market will retest that subsequently in the next session or soon after. When it doesn't test it, we call that a virgin point of control, and it should be carried forward for a couple of reasons. First reason is that you want to carry them forward as targets for if the market goes back there, it'll be drawn to these high volume nodes. Second thing is that it gives you some confirmation in terms of bias currently. And right now that's a little bit more bearish than bullish. And that's why I was saying that we have potential to roll over, because leaving those virgin points of control there untouched, especially since they're to the upside, is slightly more bearish than bullish. It's just one data point out of many, but that's what we're doing here. We're basically building a narrative out of as many data points as we can in order to give us the most complete picture of what's really going on in the market. So that being said, you've got two VPOCs now stacking here on top from the 520 and 521 session. And then if we go down here, notice that there's actually a third one much lower from the 522 session. This is also a virgin point of control because that wasn't tested either. So now you've got three VPOCs above us, and it tells us basically that the momentum is starting to accelerate a bit to the downside. So that's data point number one. The VPOCs are stacking above us. All right. Data point number two is the fact that when the value area, which is where roughly 70% of the trade was in any particular session, when it starts to break away clean like it is here from a prior value area, and you can see this value area is, I don't even think it's overlapping. This is kind of a clean break to the downside as well. That also indicates more confirmation in that direction and tells you that at least there's a little bit more confidence in that direction, right? Because what is the value area telling us? It's telling us essentially where was the volume committed? Where was the majority of the volume committed? And in this case, it's roughly 70% of the volume, being that because that's how standard deviation works, it's roughly on either side of the mean if you cut that 70% in half. So that being said, you've got value breakaway to the downside now for a couple of sessions. So a little bit of acceleration there. And the last thing I want to talk about here is the gap. And this is really, really important. There were actually two gaps in play today on this Friday, May 23rd. The first gap is the one we could call like the gap, because it's like the gap of the day, right? Basically that we gapped down. We opened relatively low. This was the 24-hour action coming into Friday morning. We opened somewhere about here, and then we filled the gap. What does that mean? That we rallied to the RTH low. And you notice that it was pretty much a perfect gap fill. We only went a few ticks inside of the prior day's range and rejected. So in that sense, you can carry that forward as bearish, because the gap fill was really just the correction of that overnight inventory that got itself overly short. And then what did the market do? It sold off once it hit that. So that's a carry forward right there. The fact that where this little red square is, that's where the market actually closed, and you can see it didn't close anywhere near the high whatsoever. It closed at the midpoint of the session. You can kind of barely see it, but these yellow lines that are straight across, those are the midpoints. We call that halfback. And so you can see that the settlement today in the ES was right at the midpoint, not a very bullish close. Now the other gap, which is very important, is the large gap, which was the gap up last week. And you can see that is all the way from here to here, and we've only filled a portion of it. Now you made some inroads into filling it in the overnight session between Thursday night and Friday, but it's important to note that the overnight activity is never contributing towards the repair of the gap. Essentially, it doesn't count. So you can just kind of forget about that. And the only activity thus far that has filled the gap was this move here on Friday, this part here below. So now what happens is we now then take the top of the gap and we move it down, right? We can delete that and we bring it down into here. And we say, okay, now the top of the gap is here. And we'll call this top of gap. And that will be our new top of the gap. And what that does for us is that also gives us a new target to kind of shoot for. If, for instance, you see weakness next week and this RTH low gets taken out, okay, then you know you've got the full gap fill target below us. You also got a virgin point of control here. That would be stop number 1, and this will be stop number 2. These are the signposts, as I call them, as you're moving forward. You want to be looking at your signposts, which are your markers ahead of where you're going to be targeting, and that's where the ES could go if we were to lose that to fill that gap. Now, last thing I want to say about the profile here is the simple fact that you want to continue to carry forward this gap for a couple of reasons. It's very, very important, because remember that all gaps should at some point fill. But the bigger takeaway, I think, is that if we trade bullish next week and we leave this gap in the rearview mirror unfilled, that's a bullish sign, right? Because it's a sign of what I call WWSHD, when what should happen doesn't. We know that the gap probably should fill. If the market ignores that and wants to leave it there much longer, go with that. Don't be forcing a short here, expecting that the gap has to fill. That's usually a road to ruin. You don't want to do that. You want to have confirmation first of probably moving below the Friday's low into the remaining unfilled portion of the gap, and then take it from there. Okay, charts to watch. I've got 3 specific charts that I want everybody to watch next week, and I think you can make some money with these. This is the dollar, and I am specifically wanted to remind you of what we talked about last week, where the dollar index, if you count back 5 bars, was sitting right here. This was it, and I was saying, are we going to break the downtrend, or are we going to break the uptrend? And it broke the uptrend, which is bearish for the dollar, obviously, but is good for dollar-denominated assets, especially such as gold and other commodities, but mainly in gold. This weakness in the dollar is something that is seriously pushing gold higher, and I think the trajectory here of the dollar should continue lower, at the very least, to retest this 98 area and potentially break lower after that. And that is very, very much going to be bullish for gold. And as the dollar has moved down all week, as you can see, what has gold done? Remember in last week's video, I talked about how the low in the dollar corresponded with the high in gold, vice versa. Well, now you have the opposite thing going on, where gold is moving, or rather the dollar is moving down, and look what happened to gold. Gold moved up pretty sharply, and now gold is at a very pivotal area right here at its downtrend, which you can measure from the high. So the question is it going to retest that 3,500 level? And I think it can. So that gives you a pretty good move to play. You got about 150 points away. You're at 3,350 right now. Ideally, there should be some pullback here. This is what I call a wedge pattern, and that is exactly what it is. Obviously, I didn't make up that term, but this is the wedge, where you have the uptrend line and the downtrend line. And somewhere in here, there should be a pullback. You'll see that gold will trade inside of here and then more than likely break out up to here. So I'm looking for any pullback to buy. I am still continuing to be a put seller in the futures market, on the options on the futures, that is a rinse repeat trade that thus far has 100% success rate for this year. And I attribute that mainly to two things. One, picking my strikes very, very carefully. And two, I don't do the trade every single day. I try my best to do the trade when gold is down, therefore pumping premium into far out of the money puts that are not going to be tested. And also when gold is in a pattern that I just don't like for whatever reason, I also stay away from it. So that increases my odds of success by a lot, because I'm not just assuming in a very mechanical basis that it's a trade that I can do every single day. The trade presents itself on most days, but it's not a trade to do every single day. So that is that on the short puts on gold. So again, we're coming right to the trend line here. Again, best case scenario here is going to be some sort of a pullback buy. If you retest the 821 here, you want to be accumulating futures contracts on the way down and looking for this move up and looking for this to retest here as well. Okay, now last but not least, last chart I want to show you is rates, because this was kind of in play this week, and I feel like at the rate of where the 10-year is now, it's starting to become a thing again. You can see that they are really starting to creep higher by a lot, and they topped out up here about 4.8, and right now the uptrend is in play, and this is basically how rates move. It's a lot of back and forth, but the uptrend is here. So as long as this area here is not broken, I think you can continue to see these rates kind of creeping higher, and I do believe equities are not going to like that. That is not going to be positive for stocks, and that is what could contribute to the rollover, as I was saying. And if some news comes that causes a spike in rates and you get from here to that 5% area very, very quickly, that could cause a shock to the markets. So don't be surprised about that. So be watching this very, very closely, and it's all going to kind of tie in, and that could actually make the markets roll over. I think right now, the way the market is looking at it, kind of in almost a too sanguine manner, if you will. It just kind of feels like, no, they're not going to go higher. They're not really going to explode up there. Everything's fine. You can see all these pullbacks keep getting bought. But a spike up in rates that surprises everybody, I think, will be a little bit of a shock to equity. So be watching that. That is one of the charts to watch for this week. Dollar, gold, and rates. All right, I want to leave you with some trade ideas here. Now, caveat, all of what I'm about to show you is long, and I must say, as I was saying earlier in the program, I am not overly confident in the market right now. I actually do not have any major long exposure right now. And as far as equities are concerned, I am very much a put seller very often, sometimes putting that together with long calls, but regardless, oftentimes just doing the put sales alone, since I'm a weekly options trader and I know where my levels are. And I feel like that's a big part of my strategy. I do want to say that I am not short any puts right now in terms of equities, so I don't really like the market here. But if the resolve here is to the upside, let me leave you with a few names that I think should look good if the broad market can carry them forward. First one is Avgo. This was pointed out to me by one of my subscribers today in the weekly room. Just the fact that as the market has come in this week, look at how tight this is. It's just sitting there. And part of that may be because nobody wants to sell it ahead of its earnings. So those are coming here in early June. So there's still some time left before those earnings. And again, if the market is bullish, this could easily break out to the upside ahead of that report. That's Broadcom, Alpha, Victor, Golf, Oscar. Let's get into another one here. This is MA and V, pretty straightforward. These kind of just look like the broad market. This is MasterCard and Visa holding that 21, could lift off of there, but I think they'll need the market to do so. I also was looking at Tesla here. It kind of caught my eye because this consolidation is very similar to the last one, where here you had a tight one that lifted to the upside, and here's another tight one that hasn't really backed off at all with the market too much, just kind of sitting there. So that also could go. This stock here, I must say I'm not too familiar with, but I pulled it out of the Investors Business Daily 50. That's called the IBD 50. It's called NUTX, NUTX Health, or Nutex probably, and it just looks good. You've got some prior highs here that you're looking to test, and you've also got some trend line support. So somewhere within this area, prior highs to the trend line is probably a support area, and the stock probably moves higher from there. And last but not least, I want to leave you with a gold name, also from the IBD 50, and that's AEM, Agnico Eagle Mines. And if I just clear this here, you can see that I think this has the makings of an inverted head and shoulders like this, and I think you probably chop around a little bit here and make the right shoulder when gold pulls back, and then you're going to make a test of this all-time high here at the 126.76 level. So keep an eye on AEM, and remember, obviously, this will trade kind of, sort of, more or less, I don't want to say 100% lockstep with gold, but it's going to move with gold. So you're going to want to be looking for a pullback in the GC, coming off that downtrend line, be accumulating shares of AEM on the pullback, and then again looking for that move when gold breaks its downtrend line. That should be the catalyst for AEM to move back up to that all-time high near 127. And that's the show for today. Thank you as always for spending a little bit of your weekend with me. Let's recap some of the things we talked about in today's program. First things first, as always, the technical picture to me is a little bit cloudy here. We know that the cash market is stuck in between the 8 and the 21 period exponential moving averages, and also sitting on some key trend lines there. So are we going to roll over or not? And if we do roll over, then I take you back to what I talked about in the market profile segment of the program. We're probably going to fill that gap fully. That's that large upside gap from last week. So keep that in mind, all right? Outside of that, remember, when the market is a little bit iffy, go with what works. Gold is working right now. You know, there's a few narratives out there that are just working that are separate from equities, and I think that's where you want to keep your focus, all right? If you can, hit that like and subscribe button. I would definitely appreciate it, and also the little bell icon so you can be notified whenever ShadowTrader.net posts new videos. As always, remember, there is a $7 one-week trial to all of our rooms right on our website, and it's always a one-click cancel. None of this BS where you have to call us or send an email or whatever. You can do it all yourself right online. Check out the Live Trading Suite, where we've got 9 moderators all week long, 2 separate rooms, stocks and options. And then, of course, there's always my room, which is the weekly options room. So if you'd like to join any of those and give us a test drive for a very, very low price, you can hit the links on our site or in the description down below, all right? Again, that's all for this week. Stay safe out there. Next week is a shortened week. Enjoy the holiday. Monday, of course, is Memorial Day. Markets will be closed. I wish you good trading and good night.